In the second option, where you're choosing not to replace the item, or you're going to replace the item with a less expensive alternative, this is where the insurance companies usually only provide the actual cash value. Let's use this other shelf as an example. This isn't a shelf at all. It's a filing system that dates back to when we used to use physical paper files. These were very expensive when we first purchased them because they were specially made to store paper files, if properly covered, could resist a fire for a period of time. But as you can see, now we're only using them as shelves. Not really much different from these other ones that were a lot less money. If this room was damaged in, say, a fire, we would not likely spend the extra money to get this fancy filing system. Rather, we'd just buy regular shelves like these ones because the fancy ones would be overkill. So the insurance company won't pay the full replacement cost of these fancy shelves, but they will pay the cost to replace them with the less expensive ones. Another great example is all of this extra tile we have stored back here. We accidentally bought way too much tile when we redid the floors, and due to special circumstances, we couldn't return the extra. So when we store them in here, now, if this was a fire and the tile was damaged, we were not going to buy a whole lot of extra boxes of tile to replace them. We'll just need a few boxes. In this case, the carrier would replace the few boxes that we replaced, but only give us the actual cash value of the boxes we weren't going to replace. The reason for this goes back to the fundamental. The policy is built to make you whole, not better. Just back to where you were before the loss, and in this second example, I had a whole bunch of tile with no use for it. So they're just going to give me the cost minus depreciation or the actual cash value.